Hi Alok, what's up?
Hi, hi, Anirudh. Very well. How are you?
Good, sir. Are we ready
Yeah, we are
to
ready.
make it happen? Chali?
Yep. So let's start. So thanks everyone for joining in on this Saturday, and super excited to welcome Anirudh, dear friend, managing partner at Artha Ventures. We will go deep into the ideas and the thesis through which Anirudh invests. Also talk about his fund uh, preferences, expectations from startups, and his take on future of investing, about new normal, and much more. Let me also take this opportunity to introduce ProfitBoard Ventures formally. So, we are happy to share that we launched our investment banking firm, private investment arm, ProfitBoard Ventures, which is headquartered in Singapore, and we help startups to raise capital and also invest directly from a point wherein they have started getting the MVP, the traction to up to a Series A level. So let me introduce Anirudh. Uh, he is a fourth generation entrepreneur and the managing partner at Artha Ventures Fund, India's first micro VC fund. Not only has he lived up to the massive expectations set by the incredible achievements of his previous generations, but has been able to successfully build an investment portfolio of 75 plus startups, of which Oyo Rooms, Baby Chakra are few to name. And he is looking to build more micro VC capital fund and want to raise more capital for that to invest into different verticals, into financial technology, artificial intelligence, to name some. It's a great journey which Anirudh has traveled from being a door-to-door salesman in Texas in earlier years in US to being one of the most prolific micro VC fund which he runs today. So his journey is inspiring and very interesting. Anirudh, thanks for joining in. Thanks for accepting this invitation. And my first my first question or query or thing which I wanted to ask you is that how come working in US in an energy company to being a micro VC in India? I mean, what's the journey all about?
So Alok, before I get started, because that journey is going to take some time. So first of all, thank you so much for inviting me. I think I think I started the lockdown with a webinar with you, and
Yeah.
I think we can successfully say we've ended the lockdown with another webinar with you. But and thank you so much for the warm intro. I definitely owe a lot to the previous generations and to this ecosystem that has obviously accepted me after being for being here. So in terms of my journey, I I say my journey would be just a lot of taking a lot of risks with my career, trying to do different things, and just saying yes to whenever the opportunity presented itself. If there was something that got me excited, I just said yes to it. And I'll start off with even how I got the job for doing a door-to-door sales job. Like nobody signs up for it. After graduation, I had actually gone to interview with a company called Stream Energy, which was the fastest growing company to $1 billion in revenue. 5.5 years it took to get to $1 billion in revenue. And I had an interview with the CEO. It was set up by a senior from college. And while I was there, the senior told me, listen, why don't you, take a look at this sales seminar that's going on, and you'll meet some really cool people. I think the guy who's running it is one of the coolest Indians I've ever met. And I said, actually, I am the coolest Indian you've ever met. So with that expectation, I walked into the room, and I was absolutely amazed with this guy who ended up being my mentor and my boss for the next 5 years, who completely just took me in, taught me the ropes. I started my career. I think within 3 days, I was in half pants, a polo shirt, and a binder, and knocking on people's doors, asking them to open the door to give me the electricity bill, and I would tell them whether they could save money on the electricity bill. That was my job. That's how I started. And so it was but I just thought that what he was talking about, the thought, the job he was talking about, was so exciting that I just took it. And I did that. Most people in that role don't even survive. I think people hardly survive 6 months. I think 98% of the people quit within the first 6 months, and then, over a year, probably less than 0.1% remain. And I survived at that job for 7 years. And what I really learned over there was the value of marketing to somebody face to face. To be able to love the word no, to be rejected multiple times a day. You knocked on 100 doors a day, you made 10 sales, you got said no to 90 times in the day, and eventually also learning how to train people, how to deal with, how to help others learn how to sell. And I think that all of that came really handy, because as the company grew, I got a chance to to lead a commercial division. And at that time, I was a top salesperson for the company. So suddenly I was told, what, do you want to quit and join this commercial side? Nobody's actually working there. You're the only person who's going to be working commercial, and you have to set up everything from scratch. And I was like, yeah, I'm making good money now. Why am I supposed to go do that? And again, just the excitement, I will do something with business owners. It'll be something interesting. Said yes to it. So I went from, 50, 60 people working together to two guys working alone, and with nobody in the office, because everybody was in the field. And we built a team of 500 people who sold door to door, business to business, feet on street model. We had 14 offices. That journey and getting a client like Suez, because we went from being like a no-name broker to becoming one of the top commercial brokers in Texas in less than 6 months. And then we got a nationwide contract with the world's largest energy company. I mean, all that journey happened in less than 1.5 years from starting my first door knock, right? And it was incredible. It was for somebody 23, 24 years old. I could not have asked for a better start to my career, right? And then obviously I became a regional manager, then the national sales manager. Then we were doing so well because energy prices were going up. There was free credit available. US was growing. Everything was awesome. Was on 100 flights a year. Just living my dream job. Like, this was the job that I wanted when I went to the US. But everything that the party does stop. 2009 comes around. Everything collapses. Our clients start saying, we cannot give you a new product because we don't know how this thing is going to end. I mean, we're back obviously 12 years later at the same place, and the business collapsed on itself, right? Because we were such a big company and with too many expenses. So long story short, I got a chance to actually buy out and continue my boss's legacy, because otherwise he had to shut down. And three of us got together, said we're not going to let this thing die. Who pooled in money, bought out the entire venture. We restructured it. We gave a small piece of it to the founder, just as a appreciation for what he had done for us over the last 5 years. And then we went about rebuilding the venture, rebuilding the name. And within 3 years, Alok, we were at a position where we were making more money than when we got, at the highest point before that recession. We were making more money than that, and we got an acquisition offer. I took it. I exited my part and moved on. My partners, stayed on. They bought me out at the same terms, and I came back to India with the intention, now I figured out America. Now India is going to be a breeze, right? And I was like, I'm going to get a chance to build something in India. It's exciting. I came here and completely was blindsided, right, with how Indian entrepreneurship works. I mean, I think entrepreneurs today have it good, because in 2012, India looked a very different country, right? To set up it took me almost 9 months to get my business set up, because name approval, then, getting bank accounts. I lived in the US for, over 12 years at that point. So all my address proof was US. India mein koi address proof nahi hai. And to deal with all of that, and I was like, how do you guys do business here? Right? Because in the US, it took me 48 hours from the time I decided the name of the business to opening a bank account, to getting a credit card, and to getting a loan from the bank to start the business, right? 48 hours in 2009. I can't do that today in India, 11 years later, right? And I think after I got, that experience, I was like, I don't understand how Indian entrepreneurs are really surviving today. And that's when the idea came, I understand how to run a business. I've done it in the US. I'm doing it in India. I'm obviously learning how to do it now. And thankfully, I have the exit capital that I do. So I can also invest with these guys and I can start helping them out. And I had two things that most Indian entrepreneurs, I believe, are traditionally weak at. Now I had sales experience, I had marketing experience, and I had the ability to recruit. I could recruit, like, because I had to recruit 50,000 people a year to retain, 500 people in sales at the end of the year. So I was a recruiting machine when it came to it, right? So, and Indian founders are typically weak at what? Sales and recruiting, right? And so it was a perfect match. I started working very closely with founders. I was somebody that was a very, very strong numbers guy. Still am a very strong numbers guy. We'll talk about that in a little bit. And it just became a full-time passion. It really was. I just said yes to going to a Mumbai Angels meeting, and it was super. It was exciting, and I was like, let's go test it out, and let's see what it is. And met people like Siddharth Ladsaria, who sort of got me started. Met Anil Joshi, who guided me on my initial strategy of how to invest. And over a period of 3 to 4 years, that just became a full-time obsession. So I gave up everything else and said, this is what's going to be my life's work for now. And then 2 years later, all of these family offices that I was working with, investing with, they came and said, when you're doing so many deals, why don't you just do a fund? It's more tax efficient. It's easier for us to write checks. We'll just write you the check. You write all the other checks. You're managing it, all of it, any which ways. And I thought, this is interesting. I mean, in 4 generations, we've actually, as a family, never even taken a bank loan to do business. But someone's asking to manage their money. Let's go convince the family on that. And I really wanted to set up something, Alok, where I could make a meaningful difference, not just for the founder, but also for my investors.
But Anirudh, I want to hold you once and I want to understand one more point,
sure.
very clearly. So one is joining a company in US as a salesman to actually acquiring that company in 2.5, 3 years. Learning
four and a half years.
4.5 years. Learning sales, getting your hands dirty, and that really helped you because now you yourself is a risk taker, so you know how to invest into risky businesses. So tell me, how have you convinced your family, because they do not invest in risky, even though stock market is also risky in that sense, but if you hold, you can actually make a lot of money. You as a startup, you really don't know what's the value of your investment, what's happening there, whether you will get your capital back or not. So how have you convinced your family and convinced them that you can actually invest in startups and make a living out of it?
So I think it's the same way I convinced them on why after 4 years of going to college in America and all the money that was spent doing it, that why I should get a job with no base pay. Door-to-door sales is if you don't sell, you make no money, right? I said, give me a chance, right? I always have I have an option, so give me a chance. And then obviously the next thing you do after that is you make sure you go and perform, and so that you're worthy of the chance given to you. So I think it's always been, even when I started investing in startups, I said, give me a chance. Let me at least, test this thing out. I have a thesis in mind. It's very clear in my head how I'm going to do this, and let the results speak for themselves. If the result is good, and it'll be very visible because I'm going to track everything, so then you will know that I'm doing well, and then there's no question whether you should push me further or not. And that's actually been how I've convinced them, even for doing the fund. I said, listen, our personal investing has done well. We've made money here. So now let me try this at an institutional level, and let me create something which can be, much bigger, and I'll invest my personal capital. I'm just asking you to, back my bet. And I think that's just been the way it has grown. And I mean, it's the same thing I would, even people in your company, right? They want a chance. You have to give them a chance, right? You should give them a chance. And say, listen, let the results speak for themselves.
And you actually being very innovative by creating an energy fund and investing into energy assets to ensure that you don't lose the capital. I think that was also very interesting.
Yeah, that so my father is very clear, right? I mean, invest all you want, but make sure you return the money. And so in startups, how do you ensure that, right? Like, there's no way for me to guarantee that the money is going to come back. But I think that restriction was very interesting because I had to now at least set up something which ensured that the principle was preserved, right? He was like, I'm okay with taking a risk on the return, but I will not take a risk on the principle. So it then got me thinking that what would be the easiest way to make this thing happen. I started looking at how people were investing in startups, and thankfully I had people like Siddharth and Anil and Taha, people like this that I met who were already a couple of years my senior in this space. And I realized you have to make investments roughly like one or two investments every 45 days. So for that, you just need a regular source of income that's going to throw out enough capital to make that investment happen. So, and I read a Warren Buffett interview at that time who talked about that why he was buying all these windmills and renewable energy projects, and he said, "Listen, I have money every month to invest." I was like, "This is exactly my problem." Obviously, with a lot less zeros than he does, but this is exactly my problem. And so I went out and started looking for a renewable energy asset. I said they throw out money. They're good for 25, 30 years. And as long as they are taken care of, they will always throw out money. They don't need further investment of capital. And went out, again, found somebody, quite funnily, found somebody off LinkedIn who was selling his asset at the time. And I got a chance to buy it, negotiated the deal, wrote the check, bought the asset. And that asset, Alok, we bought that in 2013, I think. As of last year, it has already paid back 1.2x of what we invested in it. So it is already free, and it will be throwing out cash until 2037.
Wow.
Right? Which means for another 17 years, I get to enjoy cash flows coming in, and I don't have to worry about where the money comes in to put money into startup. And I think it's a brilliant. I think any family office should be allocating. If you have a fixed income portfolio, 25% of it should be in renewables. Because if you manage it well, it is an amazing 14 to 15% IRR business. I mean, and consistent for 25 years. Like, can you tell me one business जो consistently 15 से 25 साल तक आपको 12 से 15% ब्याज दे सकता है consistently? मतलब 12 होगा या 15 होगा, zero नहीं होगा, So it's amazing.
That's so true. Now, sir, let's talk about your investments, because over the last 7-8 years, you have made massive exits. That means that you have something good in terms of how you choose startups and founders to invest in. So, Anirudh, what's your thesis? How do you invest in a startup? What do you look into a startup or a founder when you meet someone?
Well, actually, there's a lot of things to look into, right? So there's not one silver bullet, but I'll tell you the 4 core principles that we are looking at, right? We don't invest in zero revenue businesses. So we invest in businesses that have revenues. We like businesses that have a moat. It doesn't have to be IPable, but I'm just saying there should be a moat. Either your ability to scale, your ability to have lower pricing. So typically, if you're 1/10 the price that everybody else is offering, or you're 10 times faster than anybody else, that's usually the scale which will create a moat in itself, right? So and you should be solving a real human problem. It should be something that is neat to have and not good to have, right? So and lastly, we want all the founders' expectations, or the founders' personal motivations aligned with the company, right? As long as those 4 things are met, right, we're more than happy investing in those businesses, right? So I think you can bring it down to that kind of a matrix for us. Quite simply, if one of those things don't match, we're usually going to say no to something. And VC, unfortunately, is a game of 99.98% of the time you're saying no, right? And there's probably 0.1% chance or 0.2% chance that you're saying yes.
But I'm just playing the devil's advocate. Now tell me, there may be a great idea and you like the founder, but it doesn't have that revenue. But you know that this might not be a VC fundable business, but you like the idea and you know that this idea may work very well in future. So how do you have a balance between a VC mentality, which is exit in 7 years, and a business mentality where you feel that नहीं यार ये अच्छा धंधा कर सकता है, हो सकता है 7 साल में 5 साल में पैसे रिटर्न नहीं करे, but I really want to get into this. So do you get this kind of dharam sankat in your life wherein maybe I wanted to invest, but since it doesn't have a revenue, I don't know. I mean, do you get into those scenarios?
It happens. I mean, to be honest, it happens quite often, right? Because
why I'm asking you?
But I have taken chances. ऐसा नहीं कि we always experiment, right? Because I know that I'm not 100% right either. So one of the things we did recently, there's a company called Agnicool where we put money, right? So to tell you the truth, Agnicool came to us in the previous round as well, and we took there was a lot of debate internally. He is zero revenue company. They're building something for space. So what Agnicool is doing is creating creating rockets that can take a payload between about 1 kilo to up to 100 kilos to space, right? Which is a very wide space in the industry because all your SpaceX guys are going beyond 100 kilos, and they're about 10 times more expensive than what Agnicool is looking at selling at. So, but it is also a very technical business because obviously you're building a rocket, it needs all kinds of approvals and requires a massive team of very expensive scientists to work on it. When they came to us, idea was interesting, was amazing. Obviously, sounds, anything to do with space, right? Everything sounds good, right? So, but the problem was you don't have revenues, right? And you don't know whether you're going to have revenues for the next 2 to 3 years. We were internally debating it. We said, let's take a chance, right? Let's take a chance. But by the time we decided, they're already finished raising the round. We said, "Ab to yaar, ye hoga nahi." They came back to us 15 months later. Still zero revenue, but far, far ahead. But they had done one thing crucially right, which was that they had now had three signed MOUs. And by the time we finished the investment, they had about 20 signed MOUs with customers who were saying, as long as you have your test rockets reach space and you prove that your design works, we are willing to, work with you and become a paying customer. Today, they almost are close to getting their first paying customer who's paying in advance who wants their payload to be on the test flight. Abhi halat hai. So like he may not have revenue, but there is definitely intent to pay. And by the time, I had done some research, I met a bunch of people even when I was traveling who told me that this is a massive space, massive opportunity, multi-billion dollar industry. Just need to have your test flights work. One of them works, this becomes a unicorn, right? And I think that's where the conviction came that, okay, we can take this risk. We can take it on because it's not that the founders are not getting revenue. There's very clear indication in the market that this is a need of the market. But till you have a test flight, till you put something into space, no one's going to pay you for it. But now even that is changing now. There's a customer saying, listen, I don't care. I want to be on your first payload you put into space in the lower Earth orbit. So I'm willing to pay. So, which is crazy, right?
I think that's a great, and I think let's hope that it becomes India's SpaceX.
Absolutely.
And I think Indian ecosystem, Indian market is opening for that, and I see there's huge opportunity in that. So Anirudh, typically, what's your ticket size? How much do you invest, and at what stage? You said that you come at an early stage, and that's the reason I asked you about the ideation, because when you talk about a lot of early stage entrepreneurs, there may be scenario wherein you will have good ideas but still not revenue. So what's the typical? Because you have a very interesting thesis on investing and follow-up. So what's your ticket size?
So usually we invest, anywhere between 1 to 3.5 crores. And what I would call it is a late seed round. So we're not seed investors. We don't come in at ideation or early execution stage. We want to see revenues. We want to see what I'm talking about. Revenues may not always be cash, but I want validated learning.
Yeah.
And whatever you're telling me is validated. There is numbers to show what you're talking about, right? And numbers that are by proven customers, right?
I think the MVP and business model and traction. I think these three things.
Correct. And like I said, the learning must be validated. Don't come with numbers and blue sky projections kind of stuff. So for that is the stage we come in at. So usually it is after most companies have gone through an accelerator. That's usually the time when they come to us, and by the time we are done investing, they've probably got decent traction, roughly 5 to 10 lakh rupees a month in revenue. Again, I'm using revenue just because it's the easiest thing to understand. There could be other forms of validated learning, which we can obviously discuss on a case-to-case basis. Yeah. What we do with those companies is that we invest, our sweet spot is about 2 crore. We take about minimum 15% equity in the company, which covers not only the cost of putting in the money, but also the time we put into our companies. We're very, very involved investors. We have a methodology of working with our founders, talking to them on a weekly basis, helping them create their internal reporting dashboards with the intent that the founder needs to know everything that is happening in the business, and it should be easily presentable, so they know how to explain their business in the best manner possible, right? And all of this takes a lot of time, a lot of work. It's a lot of heartache. a lot of pain, right? And for that, the compensation is in our equity, right, which is 2 crore for 15%. And then as the companies start performing, what we do is that in our winning companies, the companies that are performing, we double up the size of check in the next round. So if you're coming in for a pre-series A round, you don't have to go anywhere. No angel networks are required. No, other funds are required. We'll put 4 crores into this pre-series A round as long as the company is performing. And then in the series A, we will help find the lead, and we'll go on and double up our check again and put 8 crores in the series A round. Right? So over startups coming to us can expect $2 million over 3 rounds as long as they're performing. So I think that's the uniqueness of the proposition. One of the only guys probably at a early stage committing to you that we will put up $2 million in 3 rounds.
And I tell you, that is so important for a startup because, and that's the reason I always say this to startups, that you need to raise capital from the right investors initially, because they need to help you in the follow-up rounds. And the way you have structured it is, just a second, beta bugha jao abhi, sorry. and that's the reason I tell this.
So all of us have our perils of working from home. So guys, if there's anybody who wanted to ask questions, I know.
Sorry.
Yeah, go ahead.
Sorry. So these are good and bad things about working from home.
Yeah.
Your son will come and we'll talk about his thesis of investment, but that's a different thing. So what I was saying, that it's so important because I see startups raise capital from at the early stage, and they struggle to raise capital either from the same investors, or their current investors are not able to help them to raise capital at a Series A or a pre-Series A. So the journey from the initial capital raise to a Series A, that's the most critical journey. Once you reach Series A, I mean, the chances that you will grow and you will go to Series B and further, the chances increases. So I mean, that's a great model which you have, and I think hats off to you to actually spelling out that model so clearly and committing yourself to startups wherein if you raise capital initially with you, you can actually follow up and invest them in the Series A level. I think that's a great thought, Anirudh. So moving forward, let's talk about some of your interesting exits and some of your interesting investments. You talk about Oyo. So Oyo has been the game changer for Indian startup ecosystem, and I mean, we all agree to that. And I think the success story of Oyo has attracted and influenced many investors from Valley, from other countries, to actually start investing and start looking Indian startup ecosystem very seriously. So I want you to talk about Oyo and your investment in Oyo and your exit and how that happened.
So I think Oyo, I mean, you always will have that one founder, right, that completely enamors you, right? I mean, somebody that deserved every bit of success that he got, right? And I think in that sense, Ritesh is one of those guys. I mean, at such a young age, without any, what I would say, senior education, right? So he didn't finish college, 18 years old, starts a business. To have somebody so committed to a business, so just have that bloody mentality that I'm going to succeed no matter what, right? You don't get those guys very often, right? And you have to support that kind of belief. Even if you're 18 years old, that's the kind of thing that really enamors you. And in a way, this was also a very interesting time when this investment happened. I actually was traveling from India. I'd gone for the T20 World Cup in Sri Lanka in 2012, I think that happened. And after that, from there, I was traveling to the US for signing the final paperwork for my exit. And very interestingly, when I was traveling to Sri Lanka, when I was traveling to the US, I was staying at all these Airbnbs. It was just getting popular. There's something known as an Airbnb. Never heard of it, but I got a chance to talk to the homeowners who were renting their either room or their apartment to me, and they were absolutely big fans of this thing called Airbnb. So after about a month and a half, after I finished my journey in the US, I went to Puerto Vallarta, Mexico, came back, all that happened. first business plan I get across my table is this thing called Oravel, which is saying I'm going to create a corporate Airbnb model. And corporates also want homestays. They don't want to stay in hotels. I was like, boss, I have to completely get this. And I was one of the only guys. This was part of an accelerator called Venture Nursery, right? One of the only guys who actually understood what this guy was talking about, because I had just experienced it. Airbnb तब तक India में आया नहीं था. It was still very early days. I said, this is going to work. We should do it. And led the conversation internally. We went and put in the money. I was one of the largest checks along with Siddharth into the company. And it was just, in many ways it was serendipity. In many ways, just the fact that I had traveled, just experienced it, was just the right time it came to us. And I had the time to also work with this guy. So, spent a lot of time with Ritesh, either doing mystery shopping with him or for him rather, or even working on the MIS models and things like that, even helping, connect with funds and stuff like that. So, in an overall sense, I did what I do even today, right, for him. But it's just that he was the kind of entrepreneur that could soak in all of this and make magic out of it. And I mean, where he is today, sitting at, the perch he's sitting on today, Oyo is worth more. We're talking about it before the call, right? Oyo by itself is worth more than all the hotels and restaurants in India that are listed. These companies that are listed, all of them combined, their market valuation is less than Oyo, right? So it tells you something about the kind of execution required, and that in 8 years you can completely upend an industry. That's what's going to happen in the next 10 years as more and more startups come out and do this.
And I think one of the things which I've noticed about Ritesh is the ability to hire right talent. I mean that's something which is huge about Oyo. And
I think it's also very important to add that the ability to also to fire the wrong talent, right? Because the right talent will stay as long as the wrong talent isn't there. And nothing against the person who we're calling the wrong talent. Not everybody is a fit for a company, and therefore, but it's very important to realize if somebody is not a fit, to let them go, right? And to allow somebody else to take their role who actually is a fit, and to allow the person who's getting relief to find a company where they're a fit. It's a very important portion that most founders don't realize. Sometimes you have to let people go.
And I think from that perspective, it's not only about investors, it's not only about founders to have the right timing when you start your business, but also for investors to get into a business at the right time. I mean, that's also very, very interesting. And that's where most of the investors try to ensure that they get into a company at the right time, and to see that they're part of the journey. So someone asked me just now in terms of, are you a sector agnostic, or you have a preference to a sector, or that preference keeps changing depending on the time we are in?
So the thing is, we don't look at sectors. We're a thematic fund. So we invest in themes, the themes that we've researched, we've done work on. So we invest in 3 themes in this fund. First thing we invest is in consumption. So we're investing in Indian consumption, business consumption. So we believe that this D2C wave that we're seeing is going to continue. The cost of setting up a brand is going to continue to plummet, because it'll get easier to have warehouses that you don't own, distribution lines that you haven't set up, and to go to a Shopify to set up a website, or go to an Amazon to get traffic and to get going, right? So therefore, and because now more of India will transact online, I expect 25% of Indian retail will be online will be done online in the next 5 years. So a lot of this is also going to become an online play in that sense. So we believe Indian consumption definitely is there to stay. So 30% of our fund is allocated for investing in such plays, right? Either consumer services or consumer goods. Second 30% is into anything that enables that consumption, what we call a consumption enabler. So many people forget that when you look at an e-commerce transaction, it's not just a buy and sell transaction. There's an entire industry working behind it, right? Everything from your payment gateway, which has 2 banks, Visa, MasterCard, it has a telecom angle to it. All of that is required. I have my nephew. I'm on a conference call. Can I call you back? I'll call you outside. Yeah. So we all have perils of working on Saturday evening, right? Sorry, coming back. So anything that enables consumption, right? And so that's what we call consumption enablers. So everything from fintech, point of sale loans, to logistic companies, to customer service companies, anything that would help a customer get acquired for a company, we want to invest into that. And remaining 40% is in things we call B2B. Right? So B2B is anything that enables a company to either to reach out to more customers or to reduce their cost of operations. So those are our allocations: 30, 30, and 40.
Oh, that's good to know. There's a follow-up question on that. I mean, what's your preference? Amit is asking, is it high engagement deal revenue for a couple of years or revenue with decent engagement metrics?
That's too specific, Amit. I think we'll have to look at the business. Like I said, validated is the learning validated, or is it all fluff metrics? And without I think Sequoia has invested in all kinds of businesses, so it'd be very generalized to say that they've only invested in high engagement metrics.
In fact,
if there is because why validated learning? I think if the learning is not validated, then what are we basing the decisions on?
And to add to that, I mean, I think you said it's very specific, and the search program by Sequoia is something wherein they are investing in most of the business, which is very different from the way they invested earlier. So I think everyone is learning. Everyone wants to come in at a stage wherein they can actually build a company.
It makes mathematical sense, Alok. The thing is, if you want to buy 20% of a company, right? If you try to buy it, let's say today in Oyo, you got to spend 15,000 crore rupees to get 20% of the company. When Siddharth and us venture nursery angels entered, we acquired 16% for about 75 lakhs. Obviously the risk is much higher when we came in. Today the risk in Oyo is much lower, but that's the point. I think at the end of the day, as a micro VC fund, why we call ourselves that is because we're a small fund, but we want to have very high ownership stakes in our portfolio. So roughly we'll own between 15 to 25% in all our companies, because that reduces the massive exit required to return money. Today in our portfolio, even if one company gave me an exit valuation of 500 million, I would return 2.5 times the money my investors have put in. Like, we were working on the model for Oyo. Obviously, we all want to go back and see if we had done this in the past, what would happen, right? We did the same mathematics we have for the fund and how we're investing for Oyo. We would have put in 10.5 crores into Oyo, and we would have returned 840 crore rupees back to the fund. We're a 200 crore fund. So we returned 4.2 times the capital. I don't think any of my investors would worry about the remaining 39 companies. They would be like, so that's what a micro VC can do for you, right? Because you're a small fund coming early.
And I think that's how the micro VC and angel investing should be done. You bet on companies at the initial stage, you diversify your risk, and you have a ticket size which you can really manage and go big when the company goes. Because we all know that 5 of the startups will go flip, only 2, 3 will be average, and maybe 1. So even if you have 10-15% super successful startups, you will be able to return the money back to investors comfortably. So I think that's the idea, and that's I think a model which typical investors would also have. Put in small ticket size into good companies at a point wherein you can grow, and so that's a very validated model which you have to talk about. So let's talk about some of the other deals which you have made, recent deals which you are excited about. You talked about Agnikul. Any other deal which you talk about which is really interesting and you want us to know?
So we recently did, I led around into a company called Hopspace, which is the initial idea for them was to create a cult fit, but for children. Right? But obviously in the lockdown, they've taken their entire model online. And so what they're doing now, they're creating one platform for the parent for all the kids' extracurricular activities. Everything is in one place in the platform called Hopspace. Now, as the economy opens up again, and we're getting access to physical locations, we're going back to the offline model. But now we have both online and offline. So child can either take a chess lesson by coming to a location, or they can take it online, right? And that has increased our reach. Now we can reach everybody in India, because we don't have to have a physical location anymore to be able to serve the clientele. So I think that's a very exciting model, simply because things have changed so drastically in the last 6 months that it's become, everybody is now okay with either teaching online or getting taught online.
Yeah.
This was not the case maybe 6 months ago, right? It was very difficult to get the class provider. See, the class taker, though, obviously is getting brought up on iPad and iPhones, right? But the class provider has a lot of resistance because they haven't dealt with this as a part of their upbringing. Right? Many of them are 30, 40s. Most of them have only operated laptops as recent as 10 years ago. This wasn't part of their way to teach. But now in the last 6, 7 months, they've been forced to learn all the digital tools, and they now realize that it is actually much easier to teach online because the tools are much better, right? And you can't fear it anymore. That fear factor is gone. And I think that has completely changed how edtech or this extracurricular tech, as I would call it, will operate in the future.
No, I completely agree with you. If you talk about technology adoption has been accelerated by a decade, if not by two. Yesterday, I was having a PTM for my daughter on Zoom call, and I asked the teacher that what has changed for you. Don't talk and ask me what has changed for me, because anyway, my daughter was using a tab and mobile and laptop. So what has changed? I mean, you guys have started using Zoom and have been so tech savvy. So our life has completely changed. I mean, we never could imagine that without traveling to school, without actually uh, getting into so much of hassle, we can teach at home and we can do that kind of stuff at home. And first couple of months, you rightly said, everyone's struggling in schools, and but now in the last 3-4 months, technology adoption is it's at peak, and there will be many such models with wherein the edutech in terms of activities. I was talking to one of the startups, and they were trying to build an app wherein not only in terms of all the activities which a child can do, but you can actually give different tasks to a child, and they can earn coins, and they're talking to a bank wherein that coin can be converted into real saving and real money.
Oh wow!
So tomorrow I will ask my daughter, okay, you teach your younger brother for 1 hour every day, and I will give you 20 coins. So that way we are actually uh, having them to learn about value of money at a young age. So those interesting things which used to see in Valley and which we used to see in other countries, I think with technology adoption, those things are coming up very well in India now, and I think that's the change I will talk to you in terms of the behavioral change which you see now. So, what's your take on edutech? I mean, there is a euphoria to start edutech business. Everyone wants to do that, and it's very similar to what was there 5-6 years back with food tech. All the food tech companies had the food, but
yeah, even hyperlocal was a big thing, right? Everybody was doing hyperlocal.
Yeah. So, what's your take on food tech as a sector now?
You're talking about edtech or food tech?
EdTech.
I think we're obviously in the middle of a bubble, right? I think we're literally getting overcooked at this point. And there is going to be a lot of these companies, 2-3 years from now, I don't see how at least 50% of the market, if not 80%, will survive. Right? There's probably going to be 20-25% of these companies that actually do well. But I definitely believe it's a massive space. Indian spending on education is humongous, right? And we spend a lot of our savings on education. So there's definitely, it's been a very exciting space from the day one. Like, in my first 10 companies, I had a tech company called Carniche, right? So I've been there. I've been through that journey. The only thing is that it continues to be it's there's a lot of red tapeism around it. It's not very innovative. It's not very quick to jump into innovation, right? Yes, now that the teachers are pushing for better digital tools, that's going to see a bit of change. But I wouldn't start jumping ahead of the curve, right? Don't start assuming what the government is going to do, what is going to be acceptable. I think you need to have you know you need to be tempered in your expectations, right? And if it requires a moonshot change from the government for your business to operate, I don't expect that to happen, right? If you can expect reasonable changes from a government that is trying to, trying to meet the expectations of 32 states and over 5,000 plus languages in this country, right? It's not going to happen overnight, right? Even the EdTech 2020 policy envisions it to be completely paid out by 2040, which means 20 years from now. Alok, you and I will be in our 50s by that time. So in that sense, I don't want to be overly optimistic, but I'm definitely not it's not like I'm not excited. I'm just not going to be supremely optimistic expecting things to happen overnight. I don't think that's going to happen.
Yeah. Rightly said that if you depend on government policies and those policies will determine your success of your business, then I think you are in a wrong foot. But so I met a very interesting startup. I don't know. I will also discuss that with you. Wherein so they are focusing only on economics and class 11, 12, and UPSC exams. Bootstrapped, doing very well. They are not burning cash, and they did very good revenue in last 3 4 months. And I was so impressed by the founders and their mindset and what they want to do. So those kind of startups will do very well. Either they have a good exit, wherein a larger player will come and buy up, or they will scale and do something else. But you rightly said that something to do with government policies will be a big roadblock. So
Yeah, in fact, if you're
Anirudh,
expecting government intervention to be the basis of your business success, I mean, we don't invest in such businesses because there's no moat. I mean, somebody else could also come in and do the same thing. Right?
So let's talk more about the exits, and you're talking about the interesting exits which you have done, and also you're doing currently. So what's your been exit theory? I mean, do you when you exit, do you want to exit completely or you do a partial exit? What's your view on that? And how do you determine how much to hold and exit?
So it's to be clear, there's never a right answer for exit, right? Because many times my father taught me this very early in my investment career, that once you buy a stock, don't look at the price until you're ready to sell it. Until your whatever thesis you bought the stock for, if it's 5 years, then look at the price after 5 years, right? And after you sell it, don't look at the price. Because in both situations, you're going to be getting heartache, right? Because if you bought it, went down by 5%, you could have bought, or if you sell it, it goes up, and you're like, made a mistake. So that you can never win. You can never win with the market. The market is only there to teach you. So in that sense, there are a few things that I have in mind when I'm looking at an exit, right? As a fund, we're very clear. Once we start getting outside of double-digit ownership, we start getting to 5-6% ownership in a business, where we're going to start losing a bunch of our rights. That is the time we're going to start looking for exits, right? So usually, we'll start hunting from the time we're at 10%, and then probably exit before we land up at 5 or 6%. And one thing that is very clear is that if the entrepreneur and us don't agree on where the business is headed, right now, whether it is a listed stock or unlisted stock, we don't agree on where the business is headed, it's time to exit, right? Because there's no value we provide to the entrepreneur, and there's no value the entrepreneur sees in us, right? So when that relationship is going to be a purely there as a adversarial or maybe even just a passive investor relationship, so there are a lot of opportunities in the listed space where me or my investors could make more money, right? And with much lower risk. So those things are very important. As long as the company is performing, as long as things are working well, and as long as we're able to maintain our ownership right, or at least our some of the rights we have as an investor, then and the business performing, we'll stay on as long as possible, right? I mean, till the founder literally has to kick us out, we will stay there. But other than that, I mean, those are the two scenarios where we will start hunting for an exit.
That's great to know. So, is there a way wherein so what's typically the time frame? 5 years, 4 to 5 years.
Usually, so our best exits are between 3 to 5 years. Right, Oyo was a 4.2-year kind of entry to exit scenario. There are a few businesses we're holding a little bit longer. Like we're still holding on to Purple, we still hold Exotel, we still hold Tala. It's been 7 years now. But those are businesses that are performing so well that those are the businesses where the founder will have to say, you know what, either I'm doing an IPO or you know what, we need you to exit, you know, and we're going to give you top dollar, some crazy prices for you to exit, but you need, you know, if something like that happens, different case, but otherwise, we believe these businesses will hold till their IPO.
And I just got a query on Facebook in terms of how do you evaluate a deal? I mean, you must be getting so many deals week after week, every month. So how do you ensure that, okay, these are the 10 deals I want to focus on? What's your process?
So we do one meeting a week with the entire investment team that we have. So and over there we decide on what investments to look at, what not to look at. The first filter that we have, Alok, is that we don't look at businesses that are not referred to us. If somebody writes me a cold email or somebody sends something to me on LinkedIn, you know, we have a standard reply that, listen, this, you know, please go find somebody who can refer your business to us. So maybe Alok refers something to me saying, you know, I need to look at this. Only then does it make it to our review pool. So that filters are almost 80% of the businesses right away. Second, we're very open that we need 15% for 2 crores, right? So we can go 15% for 3 crores or 15% for 1 crore. That 1, 2, 3 is also very clear, right? It's based on the amount of validated learning you have. More validated learning, more established team, you know, higher valuation. So if I take both of those, I would say roughly 95% of businesses don't, you know, are not investable for us, right? Because they're either raising too much or too little, or they're not, you know, they're coming up to us cold. In that 5%, you know, the 4 principles I talked about is very, very clear, and that shaves the list down from 5% to 3% or 2%, and usually we are writing checks to about 1 to 2% of the businesses that come into us.
Yeah. So that clears the process, and I think that will help a lot of startups. So guys, don't just send a cold email. I need to get it referred well. So Anirudh to look at it.
Because our first level of filtering is our network. Because otherwise, I will be coming to Alok to ask him for a fintech company. If Alok refers a fintech company to me, because I know he is in fintech for over 30 years now, so that's why I should listen to it, right? If I have to go to Alok, then it's there's how many companies can I ask Alok for to review, right? That's the process.
Yeah, completely agree with that. One thing which is very close to my heart, Anirudh, is Indian startups ecosystem. So I call it the fourth wave. The first was 1968 when TCS started, and then in 90s where the IT companies started. And the third, but I think those companies were, the government policies also helped them with very innovative tax incentives. We call it the sunset clause, 10A, 10B. And then the third wave was 2004, 2005, and Flipkart and Snapdeal and those companies happened in India. I was very much in Bangalore, I was working with EY at that point of time. But the fourth wave is wherein we are sitting right now, very much in the middle of pandemic, when we will see very interesting companies coming out. Do you also agree to my thought process is that now the Indian startup ecosystem, considering we have the right data penetration, considering the ecosystem is matured enough, we will see more B2B enterprise product companies coming out of India now? What's your take on that? Because I know that you love to invest in product companies, enterprise product B2B companies. So what's your take on that?
I think that's always been the case, right? I was reading some report. NASSCOM predicted Indian IT companies would be exporting 97 billion a year. 80 billion a year or something like that. Back in 2000, right? Indian companies exported 191 billion last year. I mean, the last 12 months. So what that tells you is that you always underestimate the amount of innovation or the amount of change that's going to happen. How I got lights out of that's going to happen in the long term, right? And I think therefore we were very clear in our minds that B2B SaaS was going to do well in India, because see, India is such an interesting country, 32 states, all different languages, all different ways of work, right? So many different, if you go back, and so many different religions, all under one roof. Now, this level of diversity is not available anywhere in the world, right? So if a B2B SaaS company can create a software or create a service that can go pan India. Imagine the level of flexibility that technology needs to have to be able to accommodate all of these changes. Because the way you write things in Kolkata is not the same way things are written in Chennai or in Kerala or in Punjab or in Gujarat. And you have to, or how you talk or what, or how so think about all the complexities and how flexible that technology needs to be. Once it is flexible for a pan India business, how difficult is it to go to Europe and start adding countries over there, right?
Not very
And
difficult.
and India's a cost conscious market. We know that, right? So therefore, the technology also has to get built in a very lean manner because it cannot be charging massive prices, right? But when it goes abroad, guess what? For them, we can charge them 4 times, 5 times more than what we charge the Indian customer, but our cost base remains in India. So Indian SaaS companies going abroad and doing well it shouldn't be a surprise, right? We already are a very complex country. In TCS, the book written by Subramanian Ramadurai, he talks about this. He talks about TCS was a pan India company, and when we built a software that is going to work for India, it will work for the world. And I think it's playing out. I think B2B SaaS companies like Exotel, like Nowfloats, like you know, uh, Karza that we're invested in, all of these companies will export, will go overseas, and they'll do fantastically well because they have survived and they've been brought up in a very hostile, price competitive environment in with so much requirement of flexibility to cater to an audience that is so diverse. No other platform in the world is available like what you have in India. So scale
But
India,
then,
scale the world.
but then I was talking to someone and we had a very interesting view on that. And we said that why don't we go to US, scale there because you have the right market, people are ready to pay, and then come and penetrate into India. I mean, that's also a model where many people are actually doing it because, as you
If
rightly
you want to
said,
go to US, Alok, I think you need to raise $20 million just as your seed round, because you're not going to get salespeople at the or at that cost. You'll have to go set up an office. It's an expensive country to be in. So when people try to raise $1 million and they say I'm going to go to US, I'm like, do you realize that that entire round is just going to get going in the setup cost of getting to the US? It doesn't make any sense for you to be there unless you're raising 15-20 mil right away.
yeah. So, but I agree to that. But I think the biggest challenge in India, which I was coming back to that because of this pandemic, people started using technology a lot. So, do you see that people start paying also and want to use software as a service and pay because that mindset was lacking in India? I mean that mindset change is happening.
Yeah, I think it was happening before pandemic. This is accelerated. Absolutely, it has definitely accelerated. In fact, people are graduating from Gmail now saying, I want to use Office 365 because it comes with, the cloud infrastructure. It comes with Word and all that. Definitely happening. And propensity to pay has always been there. There has never been intent to pay. Propensity to pay is there, but intent to pay has not been there. Right now, intent to pay is also there because if I'm not online, I had one of our let's say associates never pay, running a massive company, never paid for anything to do with this virus defense, right, or cybersecurity, right? Never paid. Then had one attack, right, and suddenly was on the lookout. Get me a company that will do this. So propensity to pay was there. It wasn't like it didn't have money. Intent to pay was never there. And I think that is what has really changed.
I agree with that. So I think with this, I'm done with all my queries. Anirudh, do you want to ask anything?
No, I would just say, Alok, thanks a lot for having me on the show once again. And you're doing some amazing stuff over there, and we hope to collaborate on a deal in the future and be
Very
back on the
soon.
show very soon.
Very soon. And I think you rightly said that we had our first webinar when the lockdown happened. And I think now we are having this webinar. Hopefully, this virus will go away. And the fear has gone away. So that's there. But the virus will also go away. and always good to interact with you and love to collaborate. Ajit wants, just a second, Ajit has a query, just a second. Yeah. I have an idea for first unicorn from India. Wow.
Ajit, I think I answered this question. The best thing would be, please get somebody who can refer your business to us. There's a list of people that know me. I mean, Alok obviously knows me, but and get one of them to endorse your business to us, and be happy to take a look. More than happy.
You're making my life tough.
Well, you are in my network, so I should make it. I should make it tough.
So Ajit, I think you can write an email to me with your deck. Let me have a look and let me see what we can do the best. I think that's it for now, guys. Thanks, Anirudh, again for joining in, and love to catch up with you and collaborate with you soon. Take care. Till then, thanks everyone. Thanks for joining in.
Thanks everybody.
Thanks everyone. Take care. Bye.
Bye.